Welcome, everybody, to another episode of the Tech Guys Who Invest podcast, where each week you learn how to invest wisely and safely. This week's guest, we have Taylor Loht to talk about passive wealth strategies. Welcome, Taylor.
Hey guys, thanks for having me today. I'm excited to talk with you.
Yeah, we're excited to have you on, Taylor. So let me kick it off with a question about passive wealth strategies. We know that you're a passive investor. What are some of your favorite passive wealth strategies?
Oh man, that's a huge question. So I certainly appreciate it. I'm going to try to do them justice here, and I think it makes the most sense to take a step back and understand why and what to look for before we talk about the specific strategies
Great.
that, in my opinion, are my favorites. This is all just my opinions, right? I'm just a guy who invests in stuff. So a few things that I look for in investments and that I like. We're all real estate guys here, tech guys who invest. You guys are real estate investors. Number one, I like tangible value. I like real property that actually exists and we can point to rather than paper. And I do own some crypto, but that I see that as more speculative, right? That's a little different.
Right.
Number two, cash flow. I like an investment that kicks out cash flow, has real utility that drives people to pay to use it, which again we gain in real estate. Number three, and this is kind of part of real estate investing, inexpensive long-term leverage. So as we talk now, you could buy a personal residence, single family, for under 3% for 30 years, and I'm hearing some whispers from listening to some folks about some of this forbearance might even be kicked into 40-year mortgages. I'm not an expert on that, what they're going to do, but we're going to see longer term debt coming around, which is just awesome because inflation is going to eat away the purchasing value of our money over time. And number four, really important, insurable. You can buy insurance for your real estate investments. And, it's not that expensive. It'll, cover damage and loss and things like that as long as you're properly insured. So those are the things that I look for in investments, and the way I look to big thing I'm talking about now is escaping the Wall Street casino and investing in Main Street. And so those are some of the principles that I look for: real assets, cash flow production, low cost long-term debt, and adequately insurable against physical loss and damage and all those kinds of things.
Yeah, that's awesome.
Yeah,
That's what you can do with real properties. You can insure it. I love that. With paper assets, and we'll use crypto, for example. If that goes bye-bye, I mean, you can't really recover yourself, right? That's the speculative aspect of it. So I love that you brought up the insurable part. When it comes to common passive wealth strategies, what are some of the mistakes that people are making when they're trying to build these passive wealth streams of income?
Yeah, that's a great question. And, I think we've seen changes over time, right? That as the market has kind of heated up, especially in the multifamily space. The whole time I've been a real estate investor, which is past few years, it's gone by kind of quickly, right? The mid 2010s is when I got started. At that time, folks were saying this is all too expensive. This is all going to crash. We've got 1 year left, and they're saying this in like 2015. Here we are in 2021, and they were wrong, right? And this is big guys, big experienced real estate investors saying this. And here we are all these years later, and that didn't happen. So we need to always, I think, remember that, history is filled with all-time highs. That doesn't mean things can't crash tomorrow, but we want to keep in perspective that, it's always, the future has always been uncertain. It just feels more uncertain now because we're experiencing it right now. Right. But in my opinion, when it comes to, passive income through real estate investing, I think folks are just paying too much right now. I think they're underestimating their capital expenditures, especially when it comes to whether syndicating properties or just buying, multifamily or single families. And, as we've seen the supply and the market really dry up, especially in single families, prices have exploded. And, I was just going through this the other day, and that I'm looking to buy a new primary residence, right? And I'm not going to buy on the MLS. I'm going to try to get myself a deal, right? So I'm sending out mailers to landlords who own properties that are out of date, but I can deal with that as long as I get a good deal, right? And I'm talking to some of these folks that have called me back, and their pricing expectations are above where the current market value is. And I'm going, and they need, maybe $100,000 worth of repairs. I'm going through comps and just seeing how much the sale prices have gone up just since the end of 2020, really in Q3, and how much they've flown up now where we find ourselves in Q2 of 2021. I think, I listened to one of my favorite thought leaders in the space is Ken McElroy. And when I got started, he was one of those guys early on saying, this has only got a year left. And he was wrong about that, right? But he's saying some similar things now, that this massive price escalation can't keep going. We're going to see supply come back on the market one way or another, and it's going to calm down. And I think he's probably right about that. And I try to form my opinions by listening to those who have more experience than me. So that's where, my opinion on this matter comes from.
Yeah, it's interesting. The economy right now, and just sort of the different factors or forces that are in play in the combination that they're working, has never happened before. And so even the leading experts are disagreeing. They don't know what to. I was listening to an economist on a podcast earlier who was explaining why, due to the Fed's behavior and the way current monetary policy works, it was way over my head, but he was explaining for these reasons why he thinks asset prices will continue to rise over, the next foreseeable future. And I just thought to myself, man, that goes against everything that intuitively I think. It goes against everything that a lot of other people I listen to, including some economists, think. So it's so hard to make a call. Especially as a passive investor, you've got capital that you want to put to work, but it's really hard to know what to do with that or where to look at it.
Yeah, I think it's true. And, I go back to what I said before, right? History, or sorry, the future has always been uncertain. It just feels more uncertain right now because if we rewind time 5 years, that 5 years ago doesn't feel uncertain because, okay, we know what happened.
Right.
We know what's happened in the last few years. And yeah, things are different now than they were because, we're getting out of this global pandemic. They printed all this money, da, 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 da. But still the experience of being an investor in uncertain times isn't new to anybody, in my opinion, that has been an investor. We just really kind of forget what it feels like. And I think that's really where having a long-term view comes in handy. And, regarding your point about asset prices continuing to go up, like as real estate investors, that benefits us, right? As long as asset prices continue to go up, it's all gravy, it's all money, at least as long as we already hold real estate. But that's a projection that benefits us. So I think we need to be very careful about, I suppose maybe confirmation bias isn't really the right word, but we need to be careful about listening for what we want to hear and information that could really help us. And I've listened to a lot of these debates, like on YouTube. I love, YouTube debates between, Harry Dent and Peter Schiff and Jim Rickards. I've listened to a few of those, and if you listen to all three of them, they have similar ways of coming at the problem, but they all come up with kind of different things about what they think is going to happen. But if you kind of look at what they've said over time, I like Peter Schiff. I like what he has to say, but he's a broken record about we're all screwed and everything's going to fall apart and buy gold. Right. And I like the guy, but
Yeah.
that's kind of pretty much what he has to say. So, I think it's important to be careful about where you get your information and then how you look for differing viewpoints about the future. One thing, personally, for my personal goals in future, again, taking a long-term view, I see cash as the worst place to be in the long run, right? Like reserves, cash reserves, those are all very important. Emergency funds, super, great to have. But as far as a store or a producer of value, man, I don't want cash, businesses, real estate, stuff that people can use. And I can, again, protect my downside, at least in the physical sense, by, insuring them and all of that.
Yeah, that idea that savers are losers is
Totally.
absolutely true. And I think to your point, when we say that, it sounds like we're saying don't save any of your money. That's absolutely not the case. You need to save to have that nest egg. You need to save so that if you need a new roof on that rental, that you have that covered. You're not putting it on a high interest credit card. And also having an emergency fund, right? Nobody knows what's going to happen. You can't predict the future. So having up to a certain amount, whatever that is for you, is important. But after that, saving to save, quote unquote, for like retirement is a very bad play because you're going to lose money with inflation. So I love that you brought that up. So take your money out of the mattress that it's under and go invest it in something. We prefer real estate, but hey, to each his own.
Sure. Yeah. And again, everybody needs to understand what they're investing in and make their own decision and whether or not the risks and potential rewards fit with, their goals and all of that, no matter what they invest in. But, there's been a lot of research and talk and discussion around timing the market, specifically as it relates to like stocks and bonds and stuff. There's more, I suppose, research and thought leadership around that topic. But, I think it really applies to real estate too. And I see a lot of folks, especially newer real estate investors, and this is the whole time I've been a real estate investor. And before that, right? They say, now's a bad time to buy real estate because XYZ. And they use that statement, and I'm sorry if you're out there listening and you hear this, this is not an attack on you, but he used that statement as a reason to sit on the sidelines and not even look. It's one thing if you say, I'm looking at, this is going to be a big number, but I'm looking at 200 deals a week. I'm making offers that I'm comfortable with and I can live with, and none of them are sticking, compared to it's a bad time to invest in real estate and I'm just going to sit out and wait and not look at any deals. Well, let's say the market does shift in that time. The person who's out there making offers, looking at properties, building relationships, working that muscle, they're going to be the ones to get those deals if the market does dip. And for the deals that are there, as that they find, they're going to be the ones doing them, right? So it's important to use that information on, again, going back to the uncertainty about the future, and use that as a reason to, take action, not as an excuse to sit out and not do anything. That's, they're very different between looking at deals and not finding one you like and making offers and going for it, compared to it's a bad time to invest in real estate, so I'm not even going to try. That,
Yeah,
diametrically opposed.
that's a great distinction. And that tactic you mentioned actually worked for me when I was first getting into it. It is what I think helped me get my first deal, because I was thinking, I'm worried because I don't yet know what I'm doing. So I was able to start practicing and learning and beginning, as you said, to flex the muscle. And then that did help me see when something came that did work, because I was taking action, and then I was able to act on it and feel more confident. So, I mean, I think that's some great insight there. Now, Taylor, one thing you mentioned a couple minutes ago is the word risks. What do you think are some risks of investing passively?
Well, the reality is you can lose all your money
That's a risk.
any real estate investment, right? And personally, I haven't lost money on real estate yet, and I hope to keep it that way. I haven't lost my investors' money in real estate yet. I have lost money in the stock market, which is why I'm, not a huge fan of the stock market, right? But there are folks out there. You hear horror stories of folks losing money, and losing all their money, right? I mean, you can lose the property if you can't, make the note and the lender takes it back, or there's malfeasance. I mean, I was in a deal, the first deal I invested in real estate. So I went to school for chemical engineering. I, got a degree, got a job, got money. And then I started figuring out, okay, what am I going to do with this money? And I read The Intelligent Investor by Benjamin Graham, which is really about stock investing, but it teaches the principle of looking for value, right? So I kept building in my investments, as I had money coming in. Oh, excuse me, I got a hair in my mouth. Sorry, coming off my mic. Hopefully you guys can cut that out.
Yeah, well,
So
that out.
Happens
anyway,
to Kevin all the time.
it's a cat hair. I got 2 cats, but they're in the other room. So let me pick up where I left off. So I built up some investment capital over time, decided I wanted to get into real estate in some shape, form, or fashion. I thought syndication was going to be the way I wanted to go. So I went out and learned how to evaluate syndications, dug into the business, how to look at deals, met sponsors, and ultimately started investing passively in syndications. I used my self-directed IRA at the time. Now I use that and, cash and things like that. But I invested in these 2 properties in Atlanta. And I've discussed this with the sponsor on my podcast, has been, publicly discussed. So I'm not, putting anything out there that's not already out there. But this is years ago. It's all closed. We, everybody, we bought the property. He pulled the money. He did the work. And then partway through, it became apparent to him that the property manager was mishandling funds, shall we say. Whole hullabaloo ensued. The property manager had been a general partner in the syndication. FYI, lesson I learned, a property manager in my deals will never be a general partner in the syndication. Limited partner is a different conversation, but they took him out, took his shares, replaced the property management, and then a big legal battle ensued. And that, the properties ended up selling. He actually passed away kind of in the middle of the whole thing, and property sold. We got our money back, and we made some money. The arbitration and legal battle kind of ended with his estate, and I think we were kind of saved by the market there, honestly. There were some good fundamentals to the deal, but when the property manager isn't running your property correctly for a large amount of time, and ends up being money missing, things like that, it's hard to recover. And I think in a maybe stagnant market or a down market, I feel like we could have lost money, right? And you spend enough time in this space, you meet people who lose money. Either it's some of their money or all of their money or more. As a syndication passive investor, in the deals that I'm in, my risk is limited to my investment. So my name is not on the note. My IRA's name is not on the note. So they can't come after me and my credit for my passive investments. For anybody out there evaluating syndications, you need to evaluate that, talk to the sponsor, figure that out for your own deals. But for myself, I try to keep it at that. I don't want my liability to exceed that. And I'm comfortable with my ability to evaluate these deals and find deals that I feel will, make a return, or if things really go wrong, we'll have enough value built in that we can at least, sell it and get our original capital back and limit our downside, really.
Right.
That risk is always there, regardless of the asset class. But you're right. Even with passive investing, as much as it is the holy grail, if you will, there is a possibility you could lose risk. And speaking of passive income, why should investors care about building passive wealth? What's wrong with active wealth?
I don't think there's anything wrong with that, with active wealth, right? But as Warren Buffett said, I'm going to butcher the quote, but if you don't learn to make money while you sleep, you'll work until you die, right? And there are so many possibilities, so many options out there for folks to get involved, whether it's real estate or other things. I think franchises are probably a good opportunity for a lot of folks. I'm still kind of building my knowledge base around that, but there's so many options. I don't really think there's I don't want to say there's not an excuse, but why not go for it? Why not build those passive streams of income? Because what if you can't be active one day? I mean, there's going to be one day probably where you don't want to be active or you want to be less active. So, work on building those passive streams so that you can retire on your own time or pay for the kids to go to college or whatever matters to you. My personal thing is, I'm at first I started, I want to make more money. I want to get, financially independent. I want to retire early. And eventually I realized I don't actually want to retire early. I like working on stuff. I like doing things. I have no interest in going and sitting on a beach, but I want to be financially prepared to take care of, those around me. I think as we stand today in 2021, elder care is insanely expensive. My parents are in their late 50s, they're going to turn 60 next year. And, as I grow older, I'm in my early 30s. I want to be prepared to, be ready financially. I think they're well set up, but like, what if they're not? I want to be ready to take care of them, and I want to support, causes that I care about. And I think that's really focusing on the reason why you want to, make sure you're building streams of passive income is going to motivate you to do so and go make it happen.
Yeah, it's great. And I think having some of those strong, compelling whys will propel you forward and help you not sort of fizzle out, lose interest, that kind of thing. Taylor, can you
Yeah.
talk to us a little bit about how someone with a 9 to 5 can build passive wealth, what that looks like?
Sure. So I think it's important to frame it. I don't know anybody that works 9 to 5. At minimum, it's 8 to 5. I think 9 to 5 has a better ring to it, but
Yeah.
8 to 5, typically more like 7:30 to 5:30, right? So,
Right.
I think we need to be honest about that. I'm sure the same, you guys have the same experience, and everybody out there listening probably would agree with that statement. Nobody
Yeah.
really works 9 to 5. And, I think the key really is putting one foot in front of another and really working your way in. If we're sticking with, the real estate theme, okay, you want to get into real estate. Okay, I think listening to podcasts is great. We're on a podcast right now. I host a podcast, and there are a lot of podcasts out there about investing in real estate. So start learning about the options that are out there, and also start figuring out what your goals and your assets are. And your assets aren't limited to your money. I mean, that is an important factor, right? I mean, I'm not somebody who's a thought leader on how to invest in real estate with no money down. They're out there. That's not my background. That's not something that I can comment on. But regarding, the 9 to 5 person, the 8 to 5 person, 7 to 6 person's assets, money, time is a huge one. So do you have any time outside of your day job that you can allocate to building your streams of passive income? And you might say no. Well, you got to look for ways, right? And there are a lot of really busy folks out there, and I don't want to, disrespect anybody's time, but if we're really honest with ourselves and really dedicated to going for it, we could probably trim some time out, right? If you're starting slow, start with a half an hour. Can you turn the TV off a half an hour earlier before you go to bed, and, start reading a blog post and dedicate that time? Because the reason it's important to find that half hour is because you'll probably pretty quickly turn that half hour into an hour or 2 hours and start building that up and learning and figuring out what is right for you. And then, so, you need to have those assets figured out, and time is a huge one. And then also your goals, right? And your goals are intertwined with your assets. So different streams of passive income let's say different levels of passivity, right? As a passive syndication investor in the deals that I'm in, once my money's invested, I mean, I don't do anything, right? I look at the financial statements, continue to, monitor the progress, but I'm not doing anything on managing those properties. The work was really done on the front end of finding the sponsors, evaluating their deals, and obviously doing what I could to put the money together to have to invest in the first place. And kind of the same goes for, or similar thought processes go for other strategies. If you're somebody that wants to, invest in notes or turnkeys or whatever, you need to find a way to get that deal flow going, evaluate those assets, and, figure out how to make a decision and move forward. And that will come with putting that time in, but also be aware on the back end that they have different levels of time commitments. And I'm not a note investor. I'm not a turnkey investor, right? I'm in my lane. I've chosen mine, but I'm not saying it's the best thing out there for everybody, right? You need to understand what it requires and know that on the front end, right? And this is why I kind of rail against buying like a single family rental property and self-managing for busy professionals, because mean, come on, that's another job. Like, do you really want that other job, or do you want to focus on that active income stream that you make and then get the passive guys really going and rolling? In my opinion, it's better to focus on the passive ones and be cognizant of the amount of time you need to spend to put those together and manage them and make them happen, because it's rarely zero. And there's kind of a ladder of, what takes the most time, what takes the least time.
Absolutely.
Yeah.
So let's say somebody is a step past that education. They've got money that they're willing to invest, knowing that the risk is that they could lose it all. Let's say it's not their last $50,000 or whatever the case may be. They're looking to invest.
That's good.
How would they go about finding a deal? I'm just curious what advice you would give that 9 to 5 or 7:30 to 5:30. It doesn't have the same ring to it. That
No, it
full-time working person. How do you advise them to go find a deal?
Sure. So, it varies based on whatever strategy you're going to use. And we'll stick with syndication because, I mean, that's the one I do. And that's the one that I'm familiar with the process behind. And if you've really been in the syndication, investing space, and there are groups out there for specifically passive investors, that's really what I focus on my show, is the passive investing angle. You'll generally find that the number one piece of, guidance is to look for sponsor teams first. Look for teams with, and folks with track records, with assets under management, who have delivered, on their properties in the past and know what they're doing. So, if you want to be a syndication investor, you're probably going to start there and look for syndicators that do the kinds of deals you're looking for, that have done deals in the past, and talk with them, see if they're a good fit for you, if you're a good fit for them, get on their list, and then start seeing their deals, right? Get their deals coming to you. And, it doesn't take a lot of time to get on syndicators' deal lists, but just because you're, if you're in the space, you'll know that just because you're receiving somebody's deal and seeing that their, projection is a 30% IRR, which nobody's projecting these days, but just because you see that, you'll know that it does not necessarily reflect reality, right? So you need to know how to evaluate those deals once you've evaluated the sponsors. So you get the deal flow coming in and you start evaluating the deals. In my opinion, I think every passive investor should know at a minimum pretty basic underwriting, know how to check the sponsor's math, know how to really understand the implications that their assumptions make on the return projections. And I'll go back to a fairly early experience that I had as a passive investor before I started syndicating on my own. I received a deal from a sponsor who I knew that, looked like it could be okay. I might be interested, and, I'm going to investigate a little further. So I look at their package. Okay. Looks interesting. Look at their numbers, say, great. I have a model that I built, and there are models out there that you can purchase too. Cash flow models, underwriting models. Excuse me. And I checked their math, right? And they're projecting a certain IRR. I don't recall what it is at this point. Let's say it was 17%, right? And I punch their numbers into my calculator, and I see, I'm getting like 14%. So right there, I was done, right? But I kept pulling on the thread because there might be something for me to learn. But, I'm comfortable with my math. I'm comfortable. I know how to work Excel. I see a math mistake and I'm out, but I want to learn more, right? So I continue digging deeper. There's some other guys involved with the deal who were just helping out the sponsor team in some capacity. They weren't necessarily the main GP guys, but they were going to be involved. And this is a 506B as in boy deal, meaning it couldn't be publicly solicited. They could only reach out to folks they had a pre-existing relationship, so on and so forth. There are rules around that, but they couldn't post it on social media as one of the big stipulations of that. And I look in, I find one of the guys has something on his LinkedIn about he's raising money for this deal in such and such a market. And I was like, all right, well, strike number 3, strike number 5, right? I mean, I was already out, but I reached out to the main sponsor and I said, hey, this guy's got this thing on his LinkedIn. You got to tell him. And he did. And he said, thank you, and took it and had the guy take it down. Not to be a narc, but the SEC is pretty hardcore about that stuff.
Yeah,
right?
They don't mess around.
Keep him out of jail.
Right. I'm trying to help, man. Like, I like these guys personally. I'm not going to invest in the deal, but no ill will here. But that's the kind of stuff you can uncover when you're evaluating these deals. And you're, in my opinion, right, and this I think goes for everybody else out there. Nobody cares about my money more than I do. And that goes for you, Kevin. That goes for you, Adam. Nobody cares about your money more than you do. I care about my investors' capital, right? But they're the ones that worked hard to earn it. And I do my best to utmost to respect that and put them first. But it's in a certain way, it's human nature, right? And we all got to look out for ourselves first, know how to evaluate those deals. And then, once you find a deal that you like and you want to invest in, and you work with the sponsor, you read the legal documents, which was a whole other thing all on its own, right? A PPM, an operating agreement, could be well over 100 pages, and you're going to want to read a few of those and make sure you understand the language that is involved. And you make the investment as a passive investor, get the docs and wait, basically, and evaluate, stay in touch, see what's going on. But once your investment's made as a syndication investor, typically that's it. If things go wrong, there might be things like capital calls, which thankfully we've never had to do, even throughout COVID. But that's a whole other thing, that sponsors have a provision. If they need money to come in so they don't lose the property, they can basically tell the investors, we need money, and in order to keep your ownership typically at the percentage that it is, you as a passive investor may be obligated to invest more or have your ownership diluted. Like I said, we haven't had to do that. I haven't had that happen to me as a passive investor, but it is a real possibility. I know folks that have had that happen, and you just have to be aware of it. Part of the territory.
Well, Taylor, you've shared a lot of really good and very interesting knowledge with our listeners. Who are some of your influencers? Who are people who have kind of, I don't know, helped you in some way get where you are? Can you talk to us about that?
Yeah, I mean, there are a lot, right? I mean, number one, it starts with my parents, but I know that's not really the question, right? Because nobody else can can leverage, how great my parents are. But got to give a shout out nonetheless.
That's awesome.
Yeah. So one guy is, I live in Virginia. No, another guy that lives in Virginia is Whitney Sewell. He and I kind of connected. We're both in one of the same coaching programs pretty early on in his career, and like watching his trajectory and what he's done, and his like drive and motivation for his cause, and his commitment, all those great things have been really inspiring. So I always try to make a point to give his name some respect whenever I get the opportunity, because I've learned a lot just by talking to him, let alone sitting down having dinner with him, at least pre-COVID and whenever that was possible when he would come to Richmond. But he's one guy I've learned a lot from. There are other coaches in there that have been very influential. And as a host of a podcast, you guys have probably had this happen as well. The best way to learn any of this stuff is, I mean, I love listening to podcasts, right? But above that is hosting a podcast, because when you get somebody on who's done something that you want to do, I mean, there's of course always off limits topics to some degree, but kind of ask whatever you want, ask those questions. And once you hit stop, maybe you can ask a little bit deeper and learn from their background, what they've what they're thinking moving forward, and all those big things. So it's basically nearly any guest that's been on my show is somebody that I've learned at least a little bit from, if not an incredible amount, and just been very inspired by. But nice. Yeah, Whitney, if I got to say one, Whitney's shown me a lot and taught me a lot, directly and indirectly.
Love it. We had Whitney on the show, and from our interactions with him, I had I thought he was fantastic. We were on his show. I love that the podcast community tends to give back too, so to each other, and that's a fantastic way we should be. That's abundance right there, and you'll find that investors are the same way, at least from my experience. Now, Taylor, totally. We wouldn't be the tech guys who invest if we didn't ask you a tech question. And okay. I've been mulling this over, thinking about what I was going to ask you. And then I remembered you brought up Bitcoin, or I think you said crypto. I wanted to ask you, what are your thoughts on it? Do you feel that that piece of technology is going to last? I'm just curious. And of course, I know that you're no expert in it, or I could be wrong, but I'd love to get your thoughts on that piece of tech.
Sure. So my Yeah, I would not count myself as an expert in a topic, right? My number one thought is I'm a little salty because I knew about Bitcoin. I mean, at the beginning, 2010. I mean, I set up a mining rig on my crappy, computer and I didn't make anything, right? But the saltiness around that comes because, I mean, I had $100. I had $20.
Oh,
If I'd
man.
bought
Yeah.
20 bucks worth of Bitcoin and sat on it, man, I missed that wave, right? So I'll just be honest about that. I think a lot of folks out there aren't being honest that they're a little upset they missed the wave, even though they knew about it. At least that's my case. Right now I see it as speculative. If we're honest, it's not really being used as a currency. It has a lot of potential, I think. And my big concern is the threat that it poses to kind of governmental control of how money works. If you're listening to some of these a little off the beaten path, economists, like to bring up Peter Schiff again, right? He hates Bitcoin, but his whole thing is kind of taken how the government has taken the power of, money away from the people. And his thing is real money is gold. But the government having, say, control over the money supply does bring them a lot of power. And I had a minor in economics when I went to school from a no name, not a no name, but a state university. Nothing special. I just did it for fun to learn about how it works. And it's just so fascinating with the history of the Federal Reserve and how kind of academia, and I wasn't at a high level of academia in any way, but academia kind of accepts this situation where the government controls and drives the money supply. The Federal Reserve is not an independent body. Let's just get that out of the way right now. No way, no shape, no form, no how. And they gain a lot of power by holding those purse strings to being able to run the printers at any time. And I'm 31, I'm turning 32 soon, and I think in our lifetime, I don't know whether we're going to see insane hyperinflation, but this debt that the federal government has, it's here to stay. We're never going to pay it off, and I think those chickens are going to come home to roost in our lifetime. So getting back to Bitcoin, okay, let's say there is broad, hypothetically, there is broad adoption of cryptocurrencies in general as currency. We start using them for transactions rather than kind of somewhat speculative holding, which is how I classify it now. I know that crypto guys don't like that, but let's be real. It's not really being used for a lot of purchases now. I think that could change. But if that does change, the people who in the Federal Reserve and the Treasury, headed by Janet Yellen, who's a former head of the Federal Reserve, just one more piece of evidence that the Federal Reserve is not an independent body. If they eventually figure out, and our generation's going to be in those halls of power by when the time that happens, I think, there's going to be a lot of motivation to try to make crypto, illegal or unobtainable or unusable. And I think anybody who says that's crazy, that's insane, isn't really taking a long-term view of history, because just within the last century, FDR made private ownership of gold illegal. You couldn't own gold. They took it. You couldn't have it. And we can now, right? That's changed. But why couldn't they do the same thing for crypto? And I understand that the argument that they can't stop it because it runs on the internet, which it does run on the internet. But if they say legitimate businesses can't own this, can't transact in this, you can't have it, that's the end of it, in my opinion, because there are enough people who will, I think, strive to not run afoul of the law that would be, kind of all she wrote as far as crypto as a means, as a currency, really. And I think that would be unfortunate, right? I mean, like I said, I own some of this stuff, but I'm just trying to be a realist about kind of the realm of possibilities and what it really represents as a theoretical returning power to the people, if you will. So those are some of my thoughts. Whether or not, you listen to the guys on YouTube who say it could go to $1 million a coin, I got no stinking idea, man. Today, as we're talking, I think it crested 62,000. It's great for the Bitcoin I have. I don't have that much, so it's certainly, not adding a comma to my net worth in any way, shape, or form. Not even adding one single digit to my net worth or bumping me out one. But that's kind of my thoughts about it. I think anybody looking to invest in it should acknowledge that it's really speculative. And that goes back to, again, going to tie it back to the beginning. It's not a real tangible asset. It doesn't produce cash flow. You can't get cheap leverage on it, and it's not insurable, right? So why would I lump that in my asset allocation strategy in with my real estate that actually exists, actually has hundreds of people living in it or storing their stuff in it in the case of self-storage, has pretty cheap debt on it that I'm not on the hook for, at least some of it, a lot of it, and is insured in case somebody burns it down. I mean, those are completely different realms, right?
Yeah.
And those are my thoughts about it. I'm sorry that's long-winded.
great.
I'm also happy I bought a really nice graphics card a little bit before this recent frenzy. I got it at a great price, and now I could sell it for 3 times as much, but I'm using it to mine. I'm not making that much. It's a little bit, you know, it's worth the time, but yeah, speculative, but I think worth speculating on if you're down for some speculation that could go to zero. I think it's important to remember it could go to zero.
Yeah. Yeah. I wouldn't invest anything you couldn't afford to lose, but
Exactly.
no, it's fun to invest a little bit and kind of watch it. Right.
Yeah.
Taylor, thanks
Get on
so
the roller
much.
coaster.
Right. Absolutely. Thanks for coming on. Thanks for sharing. This has been fantastic. Now, if people would like to reach out to you or, you know, just get in touch with you, where could they do that?
Yeah, absolutely. So if you're interested in seeing all the passive wealth strategies that I've lined out, there are 6. You can go to my website, passivewealthstrategy.com, and get that. Just be sent straight to your email. That's after interviewing, you know, hundreds of real estate investors, including, you know, you guys, right? And a lot of other people with expertise in those areas and lining those out. And, you know, I don't invest in all of them myself. That's not because they're bad. It's just because I'm really focused on the thing that I'm focused on. If you want to reach out to me directly, email taylor@passivewealthstrategy.com. And, you know, anybody that wants to sit down and have a chat about, you know, real estate investing, whatever, you know, you're listening to this show, again, just shoot me an email and send you my Calendly link or something like that. And we can connect.
Excellent. Great. Thanks a lot. We'll put that in the show notes for everyone's convenience. And Taylor, thanks again for coming on. This has been a lot of fun.
Hey, likewise, guys, really appreciate it. And it's been great talking here.